So I'm going to tell you what drives stock returns and why you should care and how you should use this analysis to help you generate better long-term investment results. Hi, my name is Gary Mishurs. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the Value Investing Seminar at the FW Olin Graduate School of Business. So let me break down returns in the following way, and this might be a little bit different than you thought about them in the past. So there's three components to investment returns. So the first component is price going to value. So let's think about what that means. So let's say a business is worth 100 today, but the stock is at 60. Over time the market recognizes its error, and the stock goes from 60 to 100. And the price to value gap closes. Okay, that's good. The next source of investing returns is the value changing. So let's say the value of the business is again 100, but the company is able to do something, we can talk about that in a second, that creates incremental value so that the business is now worth 150. Okay, so now, if you bought the stock at 60, as in the first example, the price to value gap should over time close not to 100, but 150, much better, right? And the third one, and I'm going to tell you this, I'm going to lead in for this, is noise, right? You have all this news, sell side analysts, you have all these, basically, people telling you about, what's going to happen next quarter, what's happening next, or what drug trial is going to report, or the quarterly earnings estimates that the company is going to meet or beat. That's kind of noise, right? That's neither in those categories. So I think as you think about the sources of value for your investments, you want to break them down to these three categories, and that's price going to value, that value changing, and noise. So if you are in that last category, if you're in the noise category, what to do is easy, just ignore it. Now, the price going to value category is relatively straightforward if you're right on the value. And by the way, value is both uncertain and dynamic. Dynamic meaning it's changing, based on events and actions of your management, or of the competitors, of the government, who knows. And we'll talk about those changes in a second. But I think as far as price going to value, usually there is some element, some problem, if there's a big gap in price and value that the market is concerned with. And once that problem is resolved favorably, that price to value gap should close. So that's kind of the first category of things. So you buy a business, maybe it's kind of a perpetuity. It's a business that you think is generating $1 of free cash flow per share. It's not growing, it's not creating much value, but you can buy that dollar for, let's say, for $6, and you think that it should be worth 10. Okay, and that's an example. So why should that gap exist? Maybe temporarily that dollar is depressed to 50 cents, and the market's saying, oh no, that company will never make the return to its prior earnings power of $1, and you think that the problem is temporary. If you're proven correct, then the gap over time should close. And by time, I don't mean 10 years. It should be, within a more reasonable time frame. Maybe it's a year, maybe it's 6 months, maybe it's 3 years, but it's not 10 years or something like that. But let's look at the more interesting component, which is that value changing. So what are some reasons the value can change? So there's two basic categories. The first category is value can change because of things outside of your company's control. And that might be favorable or unfavorable. A lot of times it can be unfavorable. So what are some examples? Some examples might be government regulation. So government comes in and says, we are the government and we're going to tell you what to do because we know what's best, which a lot of times they don't, but that's a separate discussion. But we're going to set rules for how you can operate or how you may not operate. And that's going to impact the cash flow stream of the business. Another, external, impact might be the macroeconomy and so forth. But again, these are usually not permanent. But let's say if the economy is growing, or in real terms, 3 to 5% a year, most businesses will be worth a bit more than if the economy is not growing structurally, right? So, but that's that's hard to predict, and I'm not a macroeconomist, so I don't have much to add in if it were something you could predict. But let's talk about things that your company can control that can create additional value or can destroy value. So there are two basic categories. The first is kind of operational strategic actions, and the second category is capital allocation. So I think on the strategic or operational categories, how can you create new value? Well, maybe you can come up with a new product or a new category for your business. So a somewhat recent example of that was Amazon, who came up with Amazon Web Services, AWS, which is a hugely valuable business, which didn't really exist when the company was started. So you can create a second business like that. You can also innovate in your current businesses. Maybe you can create, introduce new products, you can gain market share, or maybe you can, deepen your moat, which is a kind of a slang for increase the advantage you have over your competition by, let's say if your moat is based on a low cost position, maybe you can lower your costs further, even lower than the competition, that way making your value proposition even more attractive to your customers. The second way of increasing value or changing value is through capital allocation. And unfortunately, in that, just like in operations, you can widen your competitive advantage or lose it over time. You basically have a possibility that you can destroy value or add value. So a typical way to add value to destroy value is the CEO. He went to HBS. He has a nice suit and tie. He's fit. He gets up at 5 a.m. So he is awesome, amazing CEO, right? Well, maybe not, because maybe he gets into deal heat and pays 2x what he should pay for acquisition target, then gets on a conference call and talks about how it's strategic and synergies and all that, but then loses basically a bunch of shareholder money pursuing his ego and his hopes and dreams instead of being cold-blooded and realistic and paying an appropriate price, even if doing the deal at all. Or you might have a management that allocates capital, let's say, to a very low-risk internal project, and maybe that project for 2 or 3 years depresses profitability in a way that Wall Street is unhappy with because they're obsessed with short-term earnings. But maybe by year 5, 6, and 7, the payoff is 2-3x the invested capital, and this company has created tremendous value for its long-term shareholders. So again, depending on the actions the company takes, it can either destroy value through capital allocation, or it can add value potentially, or basically it could be neutral and just give the money back to shareholders, which arguably is what most CEOs should be doing, since they're not amazing capital allocators. So I think the way that this can help you make money is look through your portfolio and try to disaggregate your investments into which ones are mostly based on price going to current value, where you don't really expect that value to meaningfully change other than just the time value of money, versus where do you think that there is meaningful possibilities for value to grow, and what is giving rise to these possibilities. And then also try to think about how likely are these. Are these possibilities that pie in the sky, 1 in a million, or yeah, there may be not a sure thing, but maybe you think there's a very solid chance of them playing out. Thinking about your investments through that lens will also help you ask the right questions when you meet with management, or when you listen to a conference call, and when you process information, it'll help you hone in as what's really important. And what's important is, well, is this kind of, if it's a price to value kind of thesis, well, you want to get additional confirming or disconfirming evidence of whether your value estimate was right. If it's a thesis about how the value is going to drastically grow over the next 5 years or whatnot, you want to have kind of milestones to think about what's the progress on, if it's investing organically into a new business, how is that going? What are the key drivers? What are the key indicators of success, and so forth? So it's going to give you a very different lens on thinking about your investments, and hopefully ask the right questions. And maybe you'll go through some investments and you'll realize, hey, there's not a big gap between price and value, or I'm unsure what the value is, and they're really not growing value meaningfully. So maybe that's not a really good investment. And also at the portfolio level, you might be thinking, well, is my portfolio all situations where price goes to value and there's no growth in value? Is it all value growing, or is it some of each? And I think to some degree it's nice to have some of each, because different environments make it easier or harder to create value. It creates kind of a diversification in a good way among the type of investments you have, as opposed to the conventional theory of diversification by industry or some other more superficial metric. It gives you a diversification by the type of investment thesis that you're investing in. I hope this video has been helpful to you. If it has, please hit like and subscribe to my YouTube channel. Thank you.